You've lived in your home for a long time. Maybe you've raised your kids there. Maybe it's where you plan to retire. And if you've been paying attention to the market these last few years, you probably know your home's worth a lot more than it used to be. But here's the thing, that extra value isn't helping you cover your bills. You still need to fix the siding, repair the water heater, or pay down a credit card that has just crept past like 20% APR. You built all this equity, but getting access to it means applying for another loan, usually with income and credit requirements that might not really match where you're at right now. That's where home equity agreements come in. See, the basic idea here is instead of borrowing money, you're selling a future piece of your home's value. A company gives you a lump sum up front, $30K, $100K, even more even, and in exchange, you agree to share a slice of the appreciation if and when your home goes up in value later. So it's not a loan, there's no interest, no monthly payments, and it doesn't show up on your credit. Your debt to income ratio doesn't change at all. You still own and live in your home, and you can use the cash for whatever you need, whether that's debt consolidation, essential repairs, or even paying for college. So in this video, I want to walk you through exactly how these agreements work, what the trade-offs look like, because there are, and how to know if this is actually the right option for you. So one of the biggest questions people have with this kind of thing is when the money comes due, because if there's no interest, no monthly payments, how does it actually end? And the answer is very simply, you pay it back when you're ready to make a big move. That could be selling your home, it could be refinancing, or it could just be when the agreement reaches its full term, usually somewhere between 10 and 30 years down the line. Until one of those things happens, you don't owe anything back. But when that moment does come, you will repay the original amount you received, obviously, along with a fixed slice of whatever your home has appreciated since the day you signed. Not your total equity, just the increase from that point forward. So if your home's gone up $200K in value over the years, the investor will get a share in that growth. But if the market drops and your home is worth less than it used to be, they'll share in that too. So it's a fair system, but it's also a real commitment. That balloon payment may be far off, but it's not something you want to leave to chance. Best time to plan for it is the day you sign, and that starts with understanding what you're giving up. Because even though there's no interest, no loan, no impact on your credit, this isn't obviously just free money. When the funds hit your account, it won't be the full number from your quote. Most providers are going to take out a processing fee, which can be up to 4% in some cases. And of course, you got third-party costs like closing and appraisal. So if you're approved for $100,000, the actual amount might end up closer to like 94. And you got to factor in timing as well. These agreements are built to run long. If you pay it back early before your home's had time to gain real value, you can end up handing over a pretty steep share of not much. That's when the effective cost can hit 16, 18, even 20%. But over 10, 20, 30 years, that math actually starts to work in your favor because the growth compounds, the value is bigger, and the cost tends to drop, often below 10%. So yeah, there's no interest racking up in the background and no penalty for early repayment, but this only works if you treat it like what it is. It's an investment you're making in yourself with real strings attached, because this isn't something that every homeowner is going to need. But if you got value tied up in your house and no easy way to reach it, it might be the one thing that actually helps. Maybe you built up $100,000 in equity since you bought the place, but now your credit's taking a hit, or your income's tough to prove on paper, or your debt to income ratio is too high even though you've never missed a payment. You call the bank and they just say no. You're sitting on value, but you can't unlock it. That's exactly the situation this was built for, because there's no loan to qualify for, no monthly payment to add onto your plate. You get a lump sum and that is it. It also helps in situations most banks won't touch, like right after a divorce, or when you're carrying multiple mortgages, or waiting for a future refinance that's out of reach right now. If you're planning to sell soon, or you're already eligible for a decent HELOC or refi, this probably ain't for you. You got cheaper options, but this is for the homeowner who just needs a way to tap into what they already own when everyone else says no. Now, let's take a quick look at how this kind of agreement actually works in practice, because it's one thing to explain the concept, it hits differently when you see the numbers. One of the main companies offering this right now is Point, so we'll use them for a reference. They're usually able to fund between $30,000 and $600,000 depending on how much equity you've got available. The term can run as long as 30 years and with no prepayment penalty if you want to settle up early. They'll work with homeowners who have credit scores as low as 500, and they don't require traditional income documentation. So if the bank says no because your income is variable, or your DTI is just too high, or your file's too messy, they'll still take a look. They also cap the appreciation they take at the end, which does give you some protection if your home value really skyrockets. And if you paid out of pocket for big improvements like new windows or a roof or a full kitchen reno, they'll adjust for that as well. Now, I really want to stress this part. There is one big risk here, okay? And that is that repayment. Because again, you're not paying monthly, which is great in the short term, but eventually that lump sum is going to come due. Depending on how much your home's gone up in value, it can easily end up being like a 6-figure check. If you don't have the funds ready, you may need to refinance or even sell. And that's why this only works if you go into it with a long-term plan, not just for what you're doing now, but how you'll exit later. And while these agreements aren't covered under the same disclosure laws as loans, the good providers will still lay out the cost clearly. You should know exactly what you're signing. If the numbers feel vague or slippery, that is a red flag. But when the terms are solid and the structure is fair, this can be a great way to unlock equity without taking on new debt. And for the right kind of situation, that kind of flexibility makes all the difference. So hopefully this gave you a clear picture of how home equity agreements work and whether something like Point might actually be a fit for your situation. Because when your home is worth more than it's ever been, but traditional lenders won't want to work with you, getting access to this value shouldn't be impossible. And this just gives you a way to do it on your own terms. And if you're thinking about looking into Point, there's an affiliate link down in the description and in the comments section. It won't cost you anything extra, but we might earn a small commission off of it, and it really helps support the channel. And sometimes we can get you some special offers there as well, stuff you wouldn't even find on their own website. Also, if you're interested in working with us or sponsoring a future video, just reach out using the email in the description below. If you found this helpful, I would really appreciate a thumbs up and subscribe for more insights like this. If you have any questions at all, feel free to drop those down in the comments. I read as many of them as I can, and I am always happy to help. Thank you so much for watching, and I will see you in the next one.